What if the financial system didn't collapse out of nowhere, but warned us loudly before it broke, and almost everyone ignored it? Because that's exactly what's happening right now. There's a signal that has appeared before nearly every major economic disaster of the last 100 years. It showed up before the Great Depression, before the dot-com crash, before the 2008 financial crisis. And today, that same signal is flashing again. Only this time, it looks far more dangerous. It's called the yield curve inversion. And even though it sounds technical, its message is simple and brutal. The economy is under stress, and something is breaking beneath the surface. But here's the part that should worry you. This inversion isn't normal. It's deeper, it's lasted longer, and it's more extreme than anything seen before past crashes. In other words, the warning signal that preceded 1929 and 2008 is now stronger than it's ever been. And the reason this matters so much is because today's economy is far more fragile. More debt, more leverage, more dependence on cheap money, more illusions holding the system together. So when this signal flashes now, it doesn't suggest a normal slowdown. It suggests that if something snaps, the fallout could be much bigger than most people are prepared for. In this video, I'm going to explain what the yield curve really is in simple terms, why this warning is different this time, and what it means for someone trying to decide whether to buy, sell, or stay patient right now. But before we talk about what to do, you need to understand why this signal has never been ignored without consequences, and why dismissing it has been so costly in the past. Let's start there.
My name is Mac, and this is Mac Invests, where we make investing simple for ambitious beginners. If you feel lost when people throw around words like rates, recession, soft landing, and yield curve, you're not alone. And I'm not here to scare you with doom. I'm here to give you clarity. Because the yield curve isn't magic. It's not prophecy. It's a mechanism, a signal created by how money moves through the economy. And once you understand that mechanism, you stop reacting to headlines, and you start thinking like an investor. In this video, we're going to cover 3 things. What a yield curve inversion actually means in plain English. Why a long inversion can be more dangerous than it looks. And a simple, crash-proof preparation plan beginners can follow without trying to guess the exact date. Let's start with the simplest explanation you've ever heard.
Here's why so many people get confused. They hear, the yield curve predicts recessions. Then they look around and say, okay, where is it? Because the economy didn't immediately collapse. And that delay creates the most dangerous illusion in markets. If nothing happens right away, the warning must be wrong. But this delay isn't new. The yield curve can invert, and markets can still rally for a while. Because bubbles don't pop the moment the warning appears. They pop when the system finally runs out of excuses. What makes this period different is how long the warning lasted. The widely watched 2-year versus 10-year Treasury spread inverted around mid-2022 and stayed inverted into early 2024, becoming the longest continuous inversion on record, according to analysis cited by major financial reporting. Now, to be fair, this signal isn't perfect. Some strategists argue that post-2008 central bank policies and massive bond purchases may distort the signal. That criticism matters. So here's the balanced truth. The yield curve is not a crystal ball. It doesn't give dates. It doesn't promise collapse. But it is one of the clearest stress gauges in the financial system. And when that gauge stays inverted for a long time, it's telling you something important. The system has been operating under pressure, and pressure doesn't disappear. It gets transferred, which brings us to the real danger. So what is the inversion really warning you about? It's warning you about tight money. When short-term rates are high, financing becomes expensive. And in a modern economy, financing is oxygen. Here's what tight money quietly does. First, it squeezes consumers. Credit cards, auto loans, and any variable rate debt get more expensive. People don't collapse overnight. They slowly cut spending. Second, it squeezes businesses. Small businesses refinance at higher rates. Margins shrink. Hiring slows. Layoffs show up late. Third, it squeezes banks and credit. Banks become more cautious. Lending standards tighten. And when lending tightens, growth slows. Now here's where the story gets more intense. Even if inflation cools and the central bank eventually cuts rates, the damage from high rates often arrives with a delay. That's because a lot of debt resets later, not immediately. This is why the yield curve can stay inverted while markets still look calm. It's like watching a tree get eaten from the inside by termites. From the outside, it looks fine, until it suddenly snaps. And there's another reason this risk can be bigger than people expect. The modern economy is built on layers of debt and refinancing cycles. Households, companies, and governments. When the cost of money rises and stays high, something eventually breaks. Not because of opinions, not because of fear, because of math. So the yield curve isn't just saying a recession might happen. It's saying something far more important. The cost of money has reached a level where the system becomes fragile. Now let me show you the most important twist, the part most people completely misunderstand.
Here's the twist. Historically, the scary headlines don't usually start when the yield curve first inverts. They often start when it begins to uninvert, when short-term rates start falling because markets are pricing in rate cuts, stress, a recession. That's why some investors say, the inversion is the warning, the uninversion can be the event. Now, this doesn't mean a crash is guaranteed. It means the curve is reacting to a system that's already been under pressure. And even mainstream analysis acknowledges this relationship isn't simple. Sometimes the recession comes quickly. Sometimes it's delayed. Sometimes policy and liquidity change the timeline. But here's what matters for beginners. Your job is not to predict the exact date. Your job is to accept a basic reality. Fragile systems can break very fast once they start breaking. And that brings us to the most important question of all. What do you actually do with your money in an environment like this? Let's turn everything you've learned into a clear, beginner-friendly plan.
Here's the beginner plan. Simple, practical, and calm. Build your shock absorber first. If a surprise expense would force you to sell investments at the worst possible moment, that's priority number one. An emergency fund. Lower high-interest debt. Less fragility in your day-to-day life. Stop investing like the next 12 months must be perfect. Most beginners build portfolios that only work if nothing goes wrong. You want a setup that can survive multiple outcomes, not just the best one. Set rules for volatility before it arrives. Write down what you do if markets fall 10%, 20%, or 30%. Not what you feel. What you do. Keep some dry powder, even a small amount. This isn't timing the market. It's buying yourself flexibility, clarity, and emotional stability when others are stressed. Build a quality watch list now. During periods of pressure, great assets often go on sale, but only investors with a plan are able to act. And finally, use the yield curve for what it's actually good for. Not as a crystal ball, but as a reminder that the cost of money matters, and that calm markets can hide stress underneath the surface. This video is educational, not financial advice. But if you want to invest like a grown-up, you don't wait for certainty. You prepare for reality. If you want, I can make a follow-up explaining the most watched yield curve spreads, like 2-year versus 10-year and 10-year versus 3-month, in a beginner-friendly way using public data sources. Subscribe to Mac Invests, and I'll see you in the next one.